Welcome to the Tesla Economist. Please hit the thumbs up and don't forget to subscribe. If anyone is telling you they can predict a market crash, they should be immediately discredited. I like the saying, economists have predicted 7 out of the last 2 crashes. There are always plenty of people predicting the crash, and if there are always people predicting it, then obviously sometimes some people get it right. But predicting is one thing, putting your money behind it is another. A common phrase is, predicting a crash is like trying to catch knives, but it's a strategy that some investors have. Investors simply waiting to take advantage of a cycle. Buy low, sell high. The time to buy is when there's blood in the streets. When people are fearful, be greedy. When people are greedy, be fearful. Buy when everyone is selling. Hold until everyone else is buying. We've heard all the platitudes. This is known as contrarian investing, which involves going against the crowds. Charles Dow, who started the Wall Street Journal and Dow Jones Index, Dow said the market is always to be considered as having 3 movements or cycles. The first is the narrow movement from day to day. The second is the short swing running from 2 weeks to a month or more. The third is the main movement, covering at least 4 years in its duration. Speculators will try and play all these cycles. So let's explore what it's like to time the market on the long cycle, a full economic cycle of a boom, bust and recovery, and explore how particular strategies might play out. Firstly, just to point out, I usually talk about investing in Tesla, but this is a more general investing discussion, not so applicable to investing in Tesla itself, except for those of you who might be waiting for it to crash perhaps, like the ones that were telling me they were waiting until it hit $250 a share. In a crash, there are often bubbles beforehand, such as the South Sea bubble, tulip mania, the stock market before the Great Depression, and our most recent one with the mortgage-backed securities, responsible for the global financial crisis. Usually, the reason for these bubbles is greed. But is there a bubble now? Is it cryptocurrencies, electric vehicles, tech stocks, or just the market in general? You think buying when the market has crashed will be easy. You just need to wait until the crash, and then buy everything cheap. Except don't forget, there's a reason the market has crashed. There's a reason everything is cheap. You might think that it's just because no one else has enough money, because they lost it all. But that's not the only reason. It will likely be doom and gloom out there. The talking heads will be telling you this might be the end of the financial system. It may never recover. Then you're sucked into all this despair. Perhaps now you're not willing to depart with your precious cash to invest in something that might collapse. Some of the real estate you might have had your eye on in the past has now lost their tenant as they've gone out of business, which is now starting to put you off. In fact, there may have also been companies you wanted to add to your portfolio that are also struggling, and others that may even be filing for bankruptcy. Your confidence and your conviction has dwindled. It's much easier to invest in companies when everything is prosperous and you're waiting for a bargain. You may have even lost your job in the recession too, and now you need your investment savings to live on. This is why investing is not easy. It takes some serious guts to put your money in the market at these times. But it's what you've been waiting for. For most products, when prices get cheaper, people buy more. Investors are illogical and buy more when they get expensive. The stock market is an index, how investors feel about the future, not the present. It's a barometer, not a thermometer. Even if you do have what it takes to back your strategy, then it's harder to get financing. In addition to that, it costs a lot more. Interest rates have likely risen dramatically, if times are bad, due to correcting inflation. Not only that, banks aren't as keen to lend anyway. If it was property you were looking to invest, well, now it might be harder to get a loan, and it will cost a lot more. Of course, the yield from the property would have risen too, but your net return was probably fairly similar to when the times were booming. It's the capital appreciation you're really aiming for, but it could take 5 or 10 years to turn around. In the meantime, while you've been waiting for the market to crash, it's likely been an inflationary time. Inflation is actually a hidden tax. It means your money is worth less, perhaps 2% less every year, as it can buy 2% less goods. But people accept it, as their wages also increase. Except not everyone's increase proportionately. But in boom times, it can inflate a lot more, which means the cash you're holding for the crash is becoming worth less and less. In addition to that, when the economy does crash, the government used Keynesian economics to get it going again, by printing money. Printing money means all money is simply worth less, and that value has then been taken from all the citizens' money, is now the government's to do what they please in restoring the economy. Governments cannot create anything. All they can do is take money from one place and allocate it somewhere else. However, it will be done in a much less efficient way, as there is nothing more efficient than the free market. Incidentally, John Maynard Keynes' book, The General Theory of Employment, Interest and Money, has been totally discredited decades ago, yet governments still use this strategy. Although I do agree with one of his famous phrases, the market can stay irrational longer than you can remain solvent. In addition to that, in today's environment, with so much money printing and such low rates, you also add into the risk of potential hyperinflation, which means your entire cash position could become nearly worthless. After the crash in 1929, you might have gotten in and bought up all your bargains, except it dropped again in 1930, and then even more in 1931, and then even more in 1932. This is known as a dead cat bouncing. You think it's crashed, and you get in, only for it to crash again and again. It can take a long time to find the bottom. The problem is, once the bottom is discovered, it usually is a fairly quick recovery or semi-recovery. This is why it can be a good strategy to buy dividend stocks or properties with good rent, rather than trying for capital gains, as even if your stock is down, at least you have some income at what you presumably bought at a good return. Usually before the crash occurs, the last 6 months or so are the craziest. The market could actually double again, just in that short period. Then everyone gets frantic and thinks it will keep going. All the unbelievers start believing. They start thinking that this is it. Assets are always going to be for the haves, and I don't want to be a have-not. Everyone is making more money than you, even your neighbour's 18-year-old son. Eventually, you can't risk it anymore, and you finally invest, only for it to crash. And when it does finally crash, it may just be a 20% drop. It might not even be the bargain you were hoping for. Perhaps you were waiting years and watched your stock go from $100 to $300. When it finally crashes, it only drops down to $250 or so, whereas you could have got your money in when it was $100. My advice is time in the market beats timing the market. I think the statistic is only 3% of professional traders can actually beat the market. Why bother going against those odds? It's human psychology though, and emotion. Emotion has no place in investing, as it's how everyone else is playing. If you need to beat them, you have to remove emotion out of the game. Much easier said than done. But the longer you hold, then statistically your chances of making gains increase dramatically over the years. But if you do think a crash is coming, there are ways to make money when it's going down too. I'm sure most of you are familiar with the book The Big Short, or possibly more likely the movie. Well, shorting is a way of betting on the market crashing. Another way is using options too. Put options, also known as portfolio insurance. You buy a contract that gives you the right to sell a stock at a certain price before a certain date. For example, you can sell Facebook at $300 a share anytime before March 2022. If Facebook drops to $150, you can buy Facebook shares at $150 and sell them for $300. Like I said, it's also known as portfolio insurance. This is because if you are holding these shares and you are worried they might drop in value, then you can protect yourself. In fact, this might actually be something I do. If I see the market go absolutely crazy and Tesla goes up to $2,000 or something, if I don't like the look of things, then I might just buy some put options to cover myself. Not for my entire portfolio, but just enough to perhaps cover my mortgage, just in case. The point is, nothing is more unpredictable than the stock market. Thanks for listening. Please hit the thumbs up and don't forget to subscribe.